SIP versus lump sum investments. What are the differences? The recurring nature of SIP investments gives people more flexibility with when they should invest, whereas a lump sum investment needs to be timed since you are replacing your capital all at once. A low entry cost and variable monthly payments make SIPs an affordable investment. Lump sum investments are less affordable. The entire amount is paid at once. Investors have their investments averaged out thanks to the recurring nature of SIPs. This makes them low-risk investments. Lump sum investments are considered moderate to high risk as capital is invested all at once and is dependent on market performance. You can create a positive loop of compounded returns with SIPs by reinvesting the interest earned into the same SIP. With lump sum investments, you can use the interest earned and invested elsewhere, but you may not add it to the existing principal. SIPs have a minimum of 3 years as the lock-in period, and each of your investments mature one after the other instead of happening all at once, since you also place money in a recurring fashion. Lump sum investments have a one-off lock-in period. This means that your returns come to you all at once after maturing. Both SIPs and lump sum investments are effective in helping investors save and grow their wealth. To start your investment journey today, visit www.hdfcbank.com and click on Invest.